have with us TV Narendran, Managing Director and Chief Executive Officer for Tata Steel, discussing the company's latest quarter results. Thanks for talking to us, sir. First up, take us through the numbers. We've seen some sequential improvement in the India operations, not so much for the Europe operations. Take us through what are the factors at play, and more importantly, how things pan out from here on.
Thanks, Amrita, for having me on the show. Yes, it's been a better quarter than the previous quarter. If I look at India, or if I look at it at an overall level, the volumes were higher than Q3. So that played out from a benefits point of view. If you look at India, we had the benefit of higher volumes, higher prices, because steel prices went up during the quarter thanks to China opening up, and removing all the COVID restrictions. So the overall sentiment in the steel industry changed. If you look at Europe, the energy prices stopped going up. We've not got the full benefit of falling gas and electricity costs because we have a hedge on the future, and so hence the benefit of spot prices will play out for us maybe in Q2 or Q3. So if I look at India, performance has been strong, operationally strong, prices have been good, costs under control. Nilachal volumes are also helping us. So overall, it's been positive. In Europe, in Netherlands, we have some specific challenges because we are taking down, or we have taken down, a blast furnace for relining. So we had guided that we will have a couple of challenging quarters. That will continue because the blast furnace will come back only in August. That's almost like 40-45% of our production is down. So while it may not be reflected in sales because we built up some slab stocks, but the cost will be higher because you are operating at less than optimal capacity. So that's why you will see the European numbers weak for Q1 as well. Won't get worse than what it was in the last quarter, but will not get significantly better till we get to Q2. UK continues to be a challenge. We expect the EBITDA to be negative, but moving towards a better number, but still negative during this quarter. So challenges remain in Europe and will get resolved only from Q2 onwards.
Staying on the Europe point, you have a detailed commentary shared with your results statement. One of this is as a stress test for your UK, where you're expecting it to be adversely impacted. There's also a letter of support that has been extended from the parent company to the UK operations. So all this, how are you expecting that? How much of that would be the impact on your consolidated EBITDA for this financial year? And if you could give us more detail of what are the factors playing out there, recessionary fears, and how do they pan out?
So if you see the Europe EBITDA numbers are what we've reported. We don't report UK and Netherlands separately, but largely for the year, UK was negative and Netherlands was positive. So that's where it is. And that's largely been the story of most of the last 10, 12 years. The Dutch business has always been cash positive and EBITDA positive. So that challenge continues. I think the larger point for us, and which is a conversation with the UK government, is that the assets as they are in the UK cannot survive for long because they're coming to end of life. And in the next year or two, we'll have to take a call because you can't run them, as it is. Hence, our proposal was to transition into a different process route, a greener process route, and seeking support from the government because, again, the cash flows of the business don't allow us to fund that transition, based on the cash flows of the business. So that's where we are. The government has come back with a proposal which is not close to what we have asked for. And so that conversation is going. But like I said, we have to, in the next 12 to 24 months, take those calls because those assets anyway will come to the end of life.
So this proposal from the government is a more recent one, or is it the same one that we had discussed a quarter back?
Yeah, I think it's pretty much the same one. They're trying to see, what they can do. Obviously, that's a conversation which is going on with the government.
If you could give us a best case scenario and a worst case scenario for Europe. Worst case, I'm assuming, is a call in 12 to 24 months.
Yeah. The best case scenario is if the government supports a transition, you can transition to a new process route. Obviously, we'll need to syndicate this with all the stakeholders, including the unions. But a fundamental point is UK is scrap surplus. UK exports a lot of scrap, and the greenest way of producing steel today in scale is by recycling scrap. So why should a country which has scrap and is exporting so much scrap not leverage that and use more scrap in steel making. So that's where a proposal was, and it helps the UK government also meet the targets on CO2 emissions, for the country. So hence, it's not just about supporting a business which is losing money, but about creating a business which is greener and more sustainable, and we believe very important for the industrial supply chain in UK. So that's the best case scenario if we get the support that we seek. Worst case scenario is we don't get the support we seek, and then, as and when the assets come to end of life, we'll have to anyway then close it, because you can't run an asset if it's not safe. So that's where it is.
And
That's
how
all
many
we.
years would that be to the end of
Well,
life?
different assets are coming to different stages of end of life, but clearly in the next 2 years, some of the critical assets, it's more the upstream assets. It's the heavy end, the upstream, which is coming to end of life. The downstream assets are good, so they can continue running, and you can always keep the downstream assets running. It's more the upstream assets which are what we call the heavy end or the hot end, which is coming to the end of life.
Was a very explanatory answer. On staying on the macro point of view, recessionary fears for US, Europe, a couple of other markets. How do you see that playing out in terms of the overall demand for steel and also the prices in this financial year?
Actually, more than what happens anywhere else in the world, what matters is what happens in China, because that's 50% of the steel consumption. So, to me, if China recovers well, that's good for the industry. But we are conscious that China is moving away from investment-led growth to consumption-led growth. So, the steel intensity of Chinese growth going forward will be less than the steel intensity of Chinese growth in the past. So, we're conscious of that. The US, with the Inflation Reduction Act, is actually going to invest a lot of money, and that's positive. And if you look at the steel prices in Europe, I mean, in the US, it's more than $1,000 for hot rolled coils, even today. The American steel companies are amongst the most profitable in the world. So the US is quite strong. So if China is strong and US is strong, these are the two largest economies, and that has a huge impact. In Europe, the way I see it, if gas and energy prices settle as they are today, obviously the economic activity will pick up, because a lot of industries have been suffering because of high gas and energy prices. If there is any near-term chance of reconstruction in Ukraine, that's again a positive, right? Inflationary pressures are there. I think that's and rising interest rates are certainly going to be a dampener from that point of view. For Indian exporters, the fundamentals of these markets are going to be important. But otherwise, for companies who are dependent largely on domestic demand in India, I think we are on a pretty strong wicket, given the fundamentals, given the money being kept aside for expenditure on infrastructure, and given that elections are coming up next year, we expect some of these expenditures to get accelerated.
Give us a little more detailed commentary on China from the point of view. China did surprise the street, or rather shock the street, in the last 3 months in terms of lesser demand than expected. Also, the expectation that they will import more coal has not really been met so far. So, how do you see that moving? One, in terms of commodity price pressure and hence raw material price pressure, because China is not importing as much as was expected. And second, the whole steel production as well as its own consumption and supply to other markets look like.
So China went through a tough year because of the COVID restrictions. When the COVID restrictions were removed in December, there was a lot of positive sentiment, maybe in excess of what needed to be there. So everyone thought it's just going to take off, which it didn't. Because China, like I said, is fundamentally making a correction and shifting more to consumption-led growth. Okay. So if you see, automotive demand is back to 2 million cars a month, right? So you're back to 24 million cars a year. But if you look at construction activity, it is no longer as strong as it was before, right? The property sector is rebalancing itself, etc. So you have that kind of a situation which is playing out in China. Steel production has been very strong. China has, been producing all out. In fact, if I look at the March production, it's probably amongst the highest. It was about 96 million tons, which is, amongst the highest it has done in the recent past. But if the coal imports has not been high, that's also because China has adjusted itself to domestic coals and other sources of coal beyond Australia, because they were not buying any Australian coal for the last few years. So I think the coal imports is more a reflection of the changes that China has made in terms of sourcing coal. I'm sure they're buying a lot of coal from Russia, more coal from Russia than before. Steel production ramped up because everyone was positive about demand. Demand didn't ramp up as much as they expected. Hence, steel exports went up in March to about 8 million tons, which is higher than what we would like it to be. 5, 6 million tons is fine. 8 to 10 million tons is not so great. But we expect that that's a temporary thing because the Chinese Iron and Steel Association has already requested its members to cut down production because the Chinese steel companies are again back to not making any money, and hence they can't sustain it at these prices. If they drop prices and try to get the volumes out. So I think China economically will do reasonably well this year. Steel point of view will do okay, but it's in the past, if Chinese economy grew at 5%, you'd expect steel consumption to grow at 8-9%. That's not going to happen because the structure of the economy has changed. But still, I expect China to probably surprise in a positive way during the year.
And take us through your debt reduction plans. Earlier, you had indicated a $1 billion reduction every year, which you did not meet for various reasons in the last financial year. Do we see the company coming back on track with that? And specifically, how do you manage this entire cost of capital? What would be the strategy there? And what's your expectation for India's rate hike cycle?
Yeah. So if you really look at it, our debt reduction, we after we announced $1 billion a year, actually we reduced it by about 50,000 crores, right? So we did far more than that in 3 years. Now, then what happened is, of course, last year we acquired Nilachal, and because of the coal prices going up from $250 to $650, working capital really sucked in a lot of cash. So that's why last year our net debt went up because Nilachal and Rohit Ferro and some of the other ferroalloy units, meant about 10-12,000 crores of expenditure more than a normal year. And then working capital was at least 5-6,000 crores more than a normal year. So that is what is reflected in the net debt going up because we continued with our capex. We've spent about 14,000 crores of capex last year, in addition to all this, right? So if you look at going forward, we are back to that $1 billion goal. And we think in FY24, we'll be on track to reduce our debt by $1 billion because our working capital will be back to normal. The slab stocks that we built up in Europe in anticipation of the blast furnace shutdown will get used. And, we don't have a Nilachal kind of situation this year. So we're not spending that kind of money. The capex will continue to be what it was. So we are quite confident we will get back to that glide path on debt reduction.
Acquisitions on the table for this financial year?
Nothing has planned. Nothing is planned.
And what's the capital expenditure number?
I think it's about 16,000 crores for the year. Europe and India both put together. India 12,000 crores. Balance would be in Europe, mainly in Netherlands for the blast furnace relining.
And one final question. Give us some color on your India operations, what you're expecting in this financial year. How much will it help you cushion all that's happening world over? Demand and prices domestic, though domestic obviously sees a global impact on it. How are you seeing things pan out here?
Yeah, so obviously we are expecting this year to be stronger than last year. Obviously, last year we had a standout quarter in terms of Q1, but the other quarters were less than great. Q4 was not bad, but we expect a more stable kind of operation this year, hopefully picking up towards the second half of the year as the spends by the government, both in India and overseas, comes back to track. So we are expecting this year volumes also to be higher. Both India and Europe put together about 1 million and a half tons higher than last year. Because in India, the Nilachal volumes will play out in full for the full year. We'll continue to debottleneck. And then in Europe, we'll have the blast furnaces running full out in the second half of the year. So, and the sentiment in Europe should be better in this year than it was in the last year. So overall, we expect this to be a better quarter unless something very unexpected happens.
Just one added question on India. Are you expecting a pause on the rate hike cycle?
So yeah, let's see how it goes. I think inflation has come down. It's come down to below the band. So I think if we want growth back, maybe another 25 basis points. But I think beyond that, I'm sure the RBI is thinking about it. But given the global kind of situation, we have to really make sure that the India demand is strong, right? So I think all the more reason for us to hope that growth gets a bit more precedence and inflation is under control.
Hopeful on that part.
Yeah.
Thank you. Thanks a lot for your time.
Thank you. Thank you, Amrita. Thanks.